Today, we are going to talk about risk and uncertainty. Both risk and uncertainty share a lack of knowledge about a future outcome, but the concepts are not exactly the same. They differ in the following sense. In the case of risk, it is true that we don't know what will happen in the future, but we have enough data, historical data, in order to infer a probability distribution that we can apply to this particular risk. So, in a certain sense, the risk is measurable. It is true that we cannot anticipate what will happen in the future, but we can assign a probability distribution and we can assign probabilities to each outcome. This is what it is usually known as known unknowns. It is an unknown that on a certain, up to a certain extent is known, is measurable. Uncertainty is different. In the case of uncertainty, we don't have enough hard data to be able to estimate a probability distribution. So we cannot assign a probability distribution to that particular event. So the event is not measurable. It's what is usually known as unknown unknowns. When we use financial models, well, financial models are in themselves a source of uncertainty. Why? Because these models are based on a series of assumptions that never really reflect reality completely. They can be close to reality, but they are not really reflecting reality. On the other hand, even if the models were completely, we could trust them completely, we always, to make function these models, we always need to calculate, to estimate certain parameters. And these parameters always, the estimation of these parameters always also are a source of uncertainty. Let's focus on the simple case of a discounted cash flow. And let's concentrate on the case of diversified investors. When we have diversified investors, we can apply the capital asset pricing model, because remember, the capital asset pricing model takes into account only that part of risk which is not diversifiable, systematic risk. And the way the capital asset pricing model quantifies this risk is through the discount rate. A parameter beta is calculated, and this parameter beta is somehow reflecting all systematic risk related to the project. So all risk is reflected in the discount rate. The higher the risk, the higher the discount rate. The higher the systematic risk, the higher the discount rate. In the case in which we don't have uncertainty, which is the textbook case, okay, what we have is a series of cash flows that we project into the future. Actually, these cash flows have a probability distribution themselves, but actually what we discount is the expected cash flow. We don't discount the probability, we discount the expected cash flow. We have there is a certain risk around these expected cash flows, but this risk, we don't care about this risk because this risk is already quantified into the discount rate. So what we obtain is a single present value, which is the result of discounting these expected cash flows at the discount rate that includes all relevant risk, which is systematic risk, through the CAPM. What happens in real life? In real life, besides risk, we also face uncertainty. We know, for instance, that the CAPM model might not be applicable. We are not certain about the estimation of beta. And when we think in terms of the future cash flows, well, there are certain uncertainties that we cannot model. For instance, expropriation risk or risk of exchange controls or price controls, which are very typical of emerging markets. So what happens when we are facing a situation in which, besides risk, we have uncertainty is that depending on what happens with all these uncertain factors, we might end up with a different present value. So when we have risk plus uncertainty, in the end, we have a series of possible present values, as opposed to the case in which we only have risk, in which we only have one present value. The other case that we have in this table is the case of undiversified investors. In the the case of undiversified investors, is very similar to the one we explained before. The only difference is that the KPM is not applicable. We use a hurdle rate, but the conclusion is the same. The hurdle rate somehow reflects all risks which are somehow easy to anticipate, and all uncertainty in general cannot be quantified. We don't quantify it in the discount rate, so uncertainty is an additional variable. So depending on what happens with these uncertain factors, we will have different possible present values. When we need to quantify uncertainty, what shall we do? Well, in general, the way we try to quantify uncertainty is by using Monte Carlo simulation. This functions in the following way. We assign subjective probability distributions, meaning probability distributions that are not based on hard data. They are based on intuition about how these possible uncertain factors will evolve into the future. So we assign these subjective probability distributions. And there are ways to identify the probability distributions that are best suited for particular cases. So once a subjective probability distribution is assigned, for instance, to an entry variable, an input variable, like, for example, probability of expropriation, then we generate, we have what is called a random number generator. A series of random numbers are generated that are applicable, are applied to the probability distribution, and the end result is a variable for the input variable, in this case, expropriation risk or expropriation possibilities. And then in the end, for each value of this input variable, we obtain a present value. So a simulation is done for each input variable, for each value of the input variable, we obtain one present value. Of course, we can assign also probability distributions, subjective probability distributions to other entry variables or other input variables, and for each set of input variables we generate a present value for the project. So in the end we end up with a histogram for the present value of the project, so a kind of probability distribution for the present value of the project. So given that we have uncertainty, then now we have a series of possible present values, not only one single present value. Let's look at this example. Okay, here what we have this is a real example in an emerging market in which the expected present value, meaning the average present value, was 4.09 million. Okay, and this is the cumulative probability distribution that corresponds to this Monte Carlo simulation. If we look, for instance, to this value 1.7, if we say that the company is worth 1.7 million, actually, if we buy this company for 1.7 million, actually, there is only a 5% probability that we will overpay, and 95% probability that the company will be worth more. And if we go to the other extreme, 7.2 million, if we pay 70.2 million for the company, there is a 5% probability that we pay less, and a 95% probability that we pay more than we should. So in general, if we buy for 1.7 million, we buy cheap. If we buy for 7.2 million, we buy dear. The situation of the seller is the opposite in a sense. The seller sells for 7.2 million, that is a high price, so the probability that he is selling for a cheap price is very small. Okay, and most probably he will make a very good deal. And the opposite will happen if he sells for 1.7 million. It is highly probable that he is underselling. He is selling at a very low price. In the end, the final price of the company is determined by the negotiation between the parts. So this was an emerging market. Okay. Now let's imagine the case of exactly the same project, but with much less uncertainty in a developed market. Say that we have exactly the same project with exactly the same expected present value of 4.09 million, but much less uncertainty. The probability distribution in this case, the cumulative probability distribution of the developed market case, will be much steeper, meaning that there is a much narrower range, a narrower range of possible values around the expected value of 4.09 million. What is the implication of this? The implication of this is that if both projects have exactly the same expected net present value, but one of the project in the developed country has less uncertainty than the project in the emerging market, of course, we will choose the project in the developed market because the expected net present value is the same and the uncertainty is less. Even we can have a case in which the expected net present value in the emerging market is higher than in the developed market, but the uncertainty is so much higher than we still will prefer the developed market project, even if the expected net present value is slightly or is smaller than the other one. So you see that the net present value rule somehow is not exactly the same as we learn in our corporate finance courses, okay? And it is not always sure that we will choose the project with the highest net present value when we are facing uncertainty. So, summarizing, there is no such thing as a unique value for a firm or a project, even more in volatile economies or emerging markets. The best approach is to perform an objective analysis leading to a range of reasonable values, like the one we showed before on this project, whose expected net present value was 4.09 million. The larger the value to pay out for a firm, the larger the probability that the real value is lower and that the buyer ends up with a bad deal. And of course, the situation of the seller is exactly the opposite, as we explained before. And to conclude, it is possible for an investment with a lower expected net present value to be preferable if its uncertainty is considerably lower than that of another investment with a higher expected net present value. And this is all I wanted to share with you today. Until the next time.